Listen, if you're out there trying to learn inner circle trader concepts with only a $20, maybe a $50 bankroll, you really need to hear this. This explainer could literally save you months of blown accounts, not to mention a whole lot of hair-pulling frustration. I see it literally every single day. You've got these incredibly dedicated beginners, right? They're marking up their charts perfectly, they know the concepts, and then boom, they get completely wiped out by the mechanical constraints of their broker. It's heartbreaking. So today, we're going to break down exactly how you can master high-level ICT strategies. We're talking fair value gaps, liquidity sweeps, the whole shebang, without risking your entire wallet.
So you have to ask yourself, why is it that so many new traders study smart money concepts tirelessly? They backtest their strategies to absolute perfection, and yet they still repeatedly blow their small accounts in the live markets. I mean, you spend hours studying ICT, right? You map out the Asian session highs and lows, you patiently wait for the New York kill zone, but the moment you actually execute the trade, a tiny little pullback destroys you. You absolutely know the feeling. Your directional bias was 100% right, but you still walked away losing money. Well, I'm here to tell you the answer isn't your intelligence, and it definitely isn't your chart markup. It's the physical, mathematical mechanics of your trading account.
Let's get into Section 1, the small capital trap. You see, beginners are usually forced into two terrible extremes. On one hand, you have the demo account. And sure, it's financially safe, right? But it completely lacks any real emotional pressure. It's kind of like playing poker with fake chips. You just don't sweat the river card because there's absolutely no pain attached to losing. It builds fake confidence. Then, on the other hand, you jump straight into a standard account with a tiny little balance, which means you have zero breathing room. A completely normal, everyday 3-pip pullback instantly triggers a margin call. So you're basically trapped between fake psychology on the demo and just guaranteed mathematical ruin on the standard.
When you trade standard lot sizes that are just mathematically way too big for a $50 account, emotion completely overpowers your logic. Instead of reading the candles, you start staring at your P&L, watching the red numbers flash. That fear of an impending margin call completely ruins your trade management. You end up panic closing a perfectly good trade way too early, or maybe you hesitate to enter at the optimal kill zone because you're just terrified of losing whatever's left of your balance. Your execution becomes incredibly inconsistent under stress because mechanically you literally cannot afford a normal market drawdown. Moving on to Section 2, Mastering ICT Trading Psychology. Now this gets right to the core of ICT market theory. You can spend hours spotting the absolute perfect fair value gap, mapping out buy-side liquidity pools, and anticipating those pristine market structure shifts. But I'll tell you right now, all that brilliant technical analysis means absolutely nothing if your heart is pounding out of your chest because a 10-pip drawdown is going to liquidate your entire account. Professional trading is 90% psychology, and you just cannot have a calm, collected psychology when your margin is stretched to the absolute limit. It's literally impossible.
So, this begs a massive, incredibly relatable question that pretty much every struggling trader asks themselves at some point. Why does a picture-perfect fair value gap setup still result in a blown account for so many smart, dedicated beginners?
The crucial point is this, and you really need to internalize this. Your risk per pip is simply too high for your capital. In a standard account, just one standard lot is 100,000 units. Even the absolute smallest standard micro lot is way too heavy for a $30 balance. So what happens? A normal, fully expected liquidity sweep, the exact Judas swing move you actually want to see before the real expansion, accidentally triggers your margin call. You get wiped out right before the market goes exactly where you predicted, all because your lot size mathematically couldn't survive a minor fluctuation.
Which brings us to Section 3, the micro account advantage.
Let's look at the hard data here and break down what this actually means for you. Lots of beginners search for typical cent accounts to try and manage their risk. But look at FXTM's micro and ultra-low micro accounts. The contract size is incredibly small, just 1,000 units. This means you're getting the exact same risk management benefits of a cent account, but with vastly superior trading conditions. Notice the starting spreads. They drop as low as 0.8 pips, and get this, with absolutely zero commissions. You're paying less to trade in a much safer environment, which is a massive edge for a beginner who is just desperately trying to preserve their capital while they learn.
And let me tell you why this matters so much for smart money traders specifically. FXTM's ultra-low micro account actually provides VIP-level conditions for beginners. Tightening those spreads to 0.8 pips with zero hidden fees is absolutely vital if you're running expert advisors or if you're executing fast-paced ICT concepts during high-impact news events. You know, things like NFP or CPI, where wide spreads would normally hunch your stop loss and kick you out of the trade. You absolutely need those tight spreads to ensure your precise entries and exits are actually respected by the market.
But honestly, the most astonishing part? You can enter this premium zero commission environment with a minimum deposit of literally just $5. That's the price of a cup of coffee. It totally removes every barrier to entry, making professional-grade risk management universally accessible to anyone willing to put in the time to learn, without the terrifying fear of losing your rent money. You can treat this as a true stress-free educational phase.
Section 4. A Tale of Two Traders.
Let's visualize this with a quick story. Imagine a beginner trader, we'll call him Alex. Now, Alex deposits $30, super eager to trade his brand new ICT concepts. But he's using a standard account. He enters a trade at a key order block. The market does a completely routine liquidity sweep against him, pulling back just a few pips. But because his lot size is mathematically way too big, he's instantly down 40% of his account. He panics, his heart is racing, and he manually closes the trade at a massive loss. Literally an hour later, the market rockets straight to his original take profit. He gets chopped up by emotional pressure and loses all his confidence.
Okay, now let's replay that exact same scenario, except switching to a micro account changes everything. Imagine Alex switches to a true 1,000-unit micro account using that exact same $30. Now that exact same adverse market move, that routine liquidity sweep, only costs him a few cents. The paralyzing fear instantly vanishes. He stays calm, trusts his analysis, stays in the trade, the market reverses just as his ICT markup predicted, and boom, he secures a stress-free win. His psychology remains completely intact because the financial risk was actually proportional to his account size.
By trading this way, you get to practice ICT without all that crippling financial pressure. You can safely trade those tricky liquidity sweeps, you can test out your fair value gap entries, and really master market structure shifts in actual live conditions. You're backtesting new strategies with real money, which allows you to cultivate extreme, rock-solid discipline. You are finally focusing purely on your mechanical execution rather than staring in terror at a wildly fluctuating account balance. This is exactly how real professionals are forged in the markets. Let's wrap up with Section 5, your practical ICT roadmap.
All right, here is your actionable blueprint to get started today. First, learn just one ICT concept thoroughly. Seriously, don't overwhelm yourself with the entire curriculum at once. Second, backtest that specific strategy manually to prove to your own brain that it actually works. Third, and this is crucial, step into the live markets by practicing it on a micro account. Fourth, enforce strict risk management. We're talking risking only 0.5 to 1% of your small capital per trade. And finally, build consistent, boring, profitable habits over months before you ever even consider increasing your deposit.
And remember, by trading 0.01 micro lots, which is an incredibly small, safe size, you can safely test the market even on highly volatile, fast-moving assets like gold or indices. This means you can set precise technical stop losses based purely on proper market structure, rather than setting a tight, doomed stop loss just because of the terrifying constraints of your account size. You finally give your trade the room it actually needs to breathe.
The absolute core takeaway I want you to leave with today is this: learn ICT responsibly. Start small and grow consistently. Opening an FXTM micro or ultra-low micro account isn't just some random option. Mathematically and psychologically, it is absolutely the smartest, most logical way to start learning smart money concepts in real market conditions without all that emotional anxiety. You've put in the work studying. You deserve a setup that actually lets you practice what you've learned. So, I'll leave you with this final provocative thought to chew on. Are you ready to trade with discipline instead of emotion? It's time to stop letting account constraints ruin your brilliant market analysis. Take control of your trading psychology, make the switch to a micro environment, and set yourself up for real, sustainable, long-term success.